Potential challenges of central bank digital currencies, CBDCs. While central bank digital currencies, CBDCs, offer promising benefits, such as improving payment efficiency and fostering financial inclusion, they also raise significant challenges across economic, technological, regulatory, and societal dimensions. These challenges are not only technical, but also economic, legal, and geopolitical in nature. Below is a detailed breakdown of the main challenges CBDCs present. 1. Financial stability risks. A. Bank disintermediation. If individuals can hold money directly with the central bank, they might move funds out of commercial banks, especially during times of stress. This could reduce banks' deposit base, limit their ability to lend, and potentially amplify financial crises. Central banks would need to carefully design CBDCs, e.g., withholding limits or tiered interest rates, to avoid destabilizing the banking system. B. Impact on monetary policy transmission. CBDCs could alter how monetary policy tools, interest rates, reserve requirements, etc., affect the economy. For instance, if CBDCs pay interest, they might compete with bank deposits, changing how interest rate changes pass through to the financial system. Policymakers need to reevaluate liquidity management frameworks and interest rate channels. 2. Privacy and surveillance concerns. A. Transaction traceability. One major worry is that CBDCs could allow governments to track individual financial transactions in real time. This raises civil liberty and data privacy concerns, especially in countries with weaker legal protections. B. Balancing transparency and anonymity. Total anonymity, like cash, would hinder anti-money laundering, AML, and counter-terrorist financing, CTF, efforts. But full traceability threatens privacy. Designing a CBDC that balances privacy rights with regulatory compliance is a complex trade-off. 3. Cybersecurity and operational risks. A. System vulnerability. A CBDC system would be a critical national infrastructure target for cyber attacks. Attacks on CBDC ledgers or wallets could disrupt economies, undermine confidence, or lead to massive data and financial losses. B. Technology dependence. CBDCs rely on robust digital infrastructure, secure networks, reliable power, and resilient systems. Outages or technical glitches could paralyze payment systems, especially in developing economies with weaker digital frameworks. C. Interoperability risks. Ensuring CBDCs work seamlessly across banks, payment systems, and borders is technically complex. Incompatibilities may create fragmentation in global payment systems. 4. Legal and regulatory challenges. A. Legal tender status. Many countries' laws define currency as physical notes and coins. Introducing CBDCs requires revising central bank acts and payment legislation. Questions arise. What legal protections do users have? Who is liable for loss or fraud? B. AML-CFT compliance. Central banks would need to enforce anti-money laundering rules without stifling usability or privacy. Managing these compliance mechanisms at scale would be costly and complex. C. Cross-border regulation. CBDCs could make cross-border transactions more efficient, but global coordination is lacking. Differences in legal frameworks, exchange rate regimes, and data protection laws could lead to jurisdictional conflicts. 5. Technological and infrastructure barriers. A. Scalability and efficiency. A national CBDC must handle millions of transactions per second reliably, a significant technical challenge. Current blockchain and distributed ledger technologies, DLT, often struggle with throughput at this scale. B. Digital divide. Populations without access to smartphones, internet, or digital literacy could be excluded. This undermines one of the core goals of CBDCs. Financial inclusion. C. Transition costs. Upgrading payment infrastructure, training staff, and ensuring interoperability with existing systems require large public investments. 6. Political and geopolitical implications. A. Monetary sovereignty. In a globalized world, CBDCs could shift monetary power. For instance, widespread use of the digital yuan could challenge the US dollar's dominance in trade and finance. Smaller economies risk currency substitution if foreign CBDCs circulate widely. B. Cross-border capital flows. Easier digital transfers could worsen capital flight during crises, putting additional pressure on exchange rates and reserves. 7. Public trust and adoption. A. User acceptance. Public adoption depends on trust in central banks, ease of use, and perceived privacy. If citizens fear surveillance or technical insecurity, uptake could be slow, undermining the system's viability. B. Education and awareness. Many users still lack understanding of digital financial systems. Poor communication about CBDCs could lead to misuse, scams, or resistance. Other challenges. Internet access. Not all of the world's population has internet access. For example, in some sub-Saharan countries, only 23% of females and 34% of males have internet access, and the figure is between 22 to 40% for some South Asian countries. Abdichev et al., 2020. Garcia Escribano, 2020. The implementation and working of CBDCs hinges upon stable access to the internet. With current internet access, CBDCs can only be accessed by only a certain proportion of the population. It is not therefore currently possible for governments to implement expansionary monetary policy employing a CBDC that targets every individual within many countries in the advent of COVID-19. Increased capital flight risk. Having funds in the form of a digital currency might exacerbate capital flight should there be an increase in uncertainty. COVID-19 triggered panic and uncertainty in different countries. Belki and Beretta, 2020, argue that if money is in the digital form, then it is easy to siphon the money out of the country. They gave an example of Greece, where the existence of digital funds in current accounts at commercial banks aggravated capital flight. This same argument can be made for CBDCs. In addition, switching to CBDC may pose the risk of overissuance of the currency and over-reliant on the digital payment system. Belki and Beretta, 2020, Costs and Risks to the Central Bank. In the wake of COVID-19, CBDCs could have helped as they promised to be more efficient. However, implementing CBDCs could require more time. In addition, offering CBDC could be very costly for central banks. Offering a full-fledged CBDC as they are currently understood would require central banks to be active along several steps of the payment chain, potentially including interfacing with customers, selecting and maintaining technology, offering digital wallets, monitoring transactions, and being responsible for anti-money laundering, AML, and counter-terrorism funding, CFT surveillance, Bank for International Settlements 2018. Failure to satisfy any of these functions because of technological glitches, cyber attacks, or simply human error could undermine the central bank's reputation. There are also likely to be extensive costs associated with the startup of a CBDC, including infrastructure setup costs, transitional parallel running with notes and coins, and education of economic agents in their jurisdictions. Data privacy and public fear of surveillance CBDCs are said to facilitate easier monitoring of payments and linkage to identity. The collection of data may be positive, for example, giving better information to the central bank and policymakers on areas to target with monetary policy. However, the public may fear that the central bank is monitoring their habits and activities and be reasonably concerned about the security of data storage and access to and ownership of their data. A central bank able to view, evaluate, track and trace transactions may be able to prevent some transactions proceeding, or in extreme cases could freeze accounts completely. Some members of society may feel that their freedom and liberty are being restricted. Also, there is fear by some citizens that the government might use the CBDC to track their movements. Potential threats to the banking sector. Given CBDCs enable peer-to-peer payments between secure digital wallet holders, the traditional function of banks performing intermediary roles will be challenged. In particular, reduced demand for payment services and transaction accounts. Depending on the extent of migration away from conventional deposit accounts, banks and other deposit-taking institutions may experience a significant reduction in this component of their supply of loanable funds. Banks may be pressed to raise deposit rates or access more expensive and volatile wholesale funding, weighing on profitability and possibly leading to more expensive or lower provision of credit to the real economy. Central bank balance sheets and credit allocation implications. Central bank balance sheets could grow considerably in the event of high CBDC demand. Additionally, the central bank may need to provide liquidity to banks that experience funding outflows. As a result, central banks would take on credit risk and have to decide how to allocate funds across banks, opening the door to political interference. In summary, the preceding discussion shows there are a number of competing and conflicting reasons to adopt a CBDC. Ultimately, we believe that whilst COVID-19 has facilitated its contemplation, it is hard to determine if it will ultimately prove to be a catalyst. In the next video, we discuss the countries that are at an advanced stage in CBDCs and what they are doing.